Welcome back to the Long Acres Finance channel. Monthly dividend stocks are fantastic investment vehicles that return passive income to shareholders more frequently than a typical dividend stock. Who doesn't love getting paid every month instead of every 3 months, which is the most common dividend payment schedule on the market? In theory, a monthly dividend stream should accelerate the compounding effect, and in turn push the dividend snowball a little faster down the hill. And it does. Anytime you receive capital faster and redeploy it to earn you more capital, you stand to benefit from the process. But in reality, there are two factors that are necessary for dividend stocks to compound your money quickly and to grow small sums into large wealth. They are a high dividend growth rate and a strong total return. And you want these two factors to remain consistent over a long period of time. It's easy to look at history and find the perfect investment vehicle because hindsight is always 20/20. But there is another very powerful thing we can learn by looking at the past. And that is what type of actions in the past led to better than average results. The future is uncertain, but we can weave our way through this uncertainty by following a few simple principles that have been proven to work in the past. Those principles are having a long-term outlook, which has typically worked out well in the stock market, and making consistent contributions and dollar cost averaging that have also led to success in the past. Both of these principles fit very well into a dividend investing approach. And one of the best ways to build wealth and a passive income stream is with the long-term dividend snowball. Today I want to take a look at the Dividend Snowball for one of my favorite monthly dividend payers. The company is none other than Realty Income, the only monthly paying dividend stock that also happens to be a dividend aristocrat, one of the most elite dividend payers on the market. Shares of Realty Income started trading publicly in late 1994, which means the stock has a little more than 27 years of history, and that history is grounded in a consistently growing dividend stream and a solid total return. Let's say you had a spare $100 each month, and you decided to invest this cash into Realty Income starting in 1994. And you continued this process of investing $100, acquiring more shares of the company month after month till today. How much would this position be worth, and how much would Realty Income have paid you in dividends throughout the last 27 years? Your initial $100 would buy you 12.5 shares of the stock, that traded for an even $8 on November 1st, 1994. Fast forward to today, and shares of the stock trade for around $67. That's a little more than an 8 times multiple, which is very nice, but not overly fantastic, especially compared to some other companies I've already looked at. Investing $100 per month during the last 326 months equates to a total investment of $32,600. And this position would have a market value just shy of $99,000 today, without dividend reinvestment. That's a little more than 3 times your actual investment. But on top of the market value of this position, Realty Income would have also paid you a little more than $52,000 of dividend income during this time. This bumps the total return to about $150,000, which is nearly 5 times the original investment. Multiplying your money 5 times is nothing to sneeze at. But again, when I looked at Home Depot or Lowe's or even United Healthcare, each of these stocks offered significantly higher growth than Realty Income, resulting in your money growing significantly quicker. So how about if we factor in dividend reinvestment? This is really where the monthly dividend should shine and speed up the compounding machine. Reinvesting the dividend income produced from this example would lead to an additional $198,000, increasing the combined market value to nearly $300,000, which more than doubles your wealth by simply just not spending the dividend income along the way. Without dividend reinvestment, Realty Income would have paid you about $52,000 in dividend income. With dividend reinvestment, the total dividend income paid would increase to about $117,000. That's 55% more dividend income that you would receive. Also, your original investment of $32,600 would multiply about 9 times, versus only 5 times without dividend reinvestment. That's a very strong level of growth. And even though it's not as great as what we saw with Home Depot and Lowe's, it is still faster than inflation and significantly better than a bank savings account. Let's talk about why Home Depot and Lowe's were able to offer a much better dividend snowball than Realty Income. It really stems from 3 reasons. The first being the time period used in the analysis. If you watched my breakdown of Home Depot or Lowe's, you might recall that both these companies were reviewed starting in 1985, and the additional 8 or 9 years really makes a huge difference. But even if we trim the analysis for Home Depot and Lowe's to start in November of 1994, both companies still crush Realty Income and would have grown your wealth about twice as fast. Reasons 2 and 3 are that both Lowe's and Home Depot increased their dividend rates faster and had better share price appreciation than Realty Income. Both home improvement stores were also able to keep these higher growth rates more consistent during this time period. If you recall, in the beginning I stated that these 2 factors are the most important when it comes to building wealth with dividend stocks. Realty Income, with the exception of 2013, has never increased its annual dividend rate by more than 10%. 1995 doesn't really count since the company only paid 2 monthly dividends in 1994. If you compute the average annual dividend growth rate for Realty Income, excluding the year 1995, you come up with 4.54%, which is a rather weak dividend growth rate. The trailing 10-year dividend growth rate is 5.02%, but that is overstated by the large 22% increase in 2013. That is an outlier for the company. Looking at the share price appreciation, a quick back-of-the-envelope calculation shows a little more than 8% annual growth. That's a very respectable growth rate. Combining it with the dividend income and the compounding effect, it will easily be in the double digits, meaning that Realty Income most likely outpaced the S&P since 1994 in terms of total return. But both these factors simply do not stack up against Home Depot and Lowe's. Since there are only 27 years of history for Realty Income, it's not really fair to judge its results against Home Depot or Lowe's. So how about if we forecast another 8 years for the stock based on its historical averages? Where can our $100 per month investment into Realty Income take us in the future? I'm going to assume a consistent 8.26% annual share price growth and a 4.5% annual dividend growth rate. Jumping out over the next 8 years would mean that we would contribute about $10,000 more into the stock, bringing our total investment to $42,200. Without dividend reinvestment, the market value of our position would be about $201,000, and we would have generated about $95,000 in additional dividend income. So in the next 8 years, we would more than double our wealth from the past 27 years, going from about $98,000 to about $201,000. Sounds pretty sweet to me. And we would nearly double the dividend income we would receive as well. If we opted to reinvest the dividend income along the way, our total wealth would be about $770,000. That's nearly $400,000 more than without dividend reinvestment. And the total dividend income received jumps from about $95,000 to about $264,000. What we can take away from this example is that even though Home Depot or Lowe's would have grown our wealth faster, the compounding effect played a much more significant role for Realty Income. This is because of the more frequent dividend distribution, and Realty Income also happened to offer a higher dividend yield than both other stocks. I actually own positions in all 3 of these companies, and I am pretty happy with how they have performed in the past. It's a difficult task to pick the next best stock that will reward you with significant wealth. I prefer to pick a handful of stocks and take my chances that one or some of them will offer strong dividend growth and above average total returns in the future. If you can hop along for the ride with 1 or 2 wonderful companies, it can certainly lead to great wealth, even if you invest in some losers along the way. I hope you enjoyed the content. Thank you for watching. Don't forget to like and subscribe. See you next time.